Everybody, new phone holder. Obviously the mirror looks terrible, but it is what it is. So let's talk about some capital gains. Hear it all the time. Oh my gosh, I don't want to pay capital gains. Oh my gosh, capital gains are the worst. They're the worst. And I hear you, right? Nobody likes paying taxes. Steven doesn't like paying taxes. But are they really that bad? Like most people, and I'll say by most people, 98% of the people that I talk to in general, just general homeowners or maybe people thinking about getting into investing, have no clue how they work. They've just always heard the name and always heard it's just the worst thing ever and so terrible. But are they really that bad? I'm going to give you a different perspective than probably what most people are going to on capital gains. I'm going to explain how they work, right? So I'm going to start with the easy part first. You as a homeowner, if you own your home and you live in your home 2 full years and you close on 2 full years and 1 day, for example, so you live there 2 full years, if you are single, you do not pay any taxes on up to $250,000 of profit. Not the sales price, not has nothing to do with all that. It's basically your profit of your walk away, right? So what you paid for it. So easy numbers here. Let's say you bought a house for $100,000, you're selling it for $200,000. Let's say after all the fees, you walk away with $90,000. You do not pay taxes if you've been there at least 2 years. That's $90,000 cash in hand at the title company for you to go and put in your bank account, and you pay no taxes on it because you've lived there 2 years. Now, if you are married, you will get up to $500,000 tax-free money if you have lived in your home for 2 years or more. And again, this is on the profit. So another example, a little bit extreme, you bought the house for $100,000, you put, as a major fixer-upper, you put $200,000 into it, you turned around, and then you took $200,000 of repairs and updates and all that stuff, you turned around, and then you sold it for $800,000. Now, you only bought it for $100,000, now you're selling it for $800,000, which means, let's just say again, to walk away $700,000, or say there's no fees in there for the sake of the video. But you've spent $200,000 in repairs that you need receipts for. You need to keep all this, to document, right? And you cannot write off your own manual work. So if you went and updated a tile shower, you can write off, sure, what you paid for the tile. Again, consult with the CPA on this. I'm just giving you my opinion. I'm not a tax professional. I am very proud of the tax knowledge that I have learned and like to share that with people. But please, again, I'm not no tax professional. But anyways, you can write off the tile that you're, or not, I'm sorry, you cannot write it off, but you can write it off against the profit upon the sale. But you cannot write off because you spent, 100 hours working. You can't say, well, I'm charging $30 an hour, blah, blah. Now, if you paid a contractor to do it, yes, again, keep all the receipts. That can go against the profit, right? Because that's you investing your own money into it. So when you sell it, you need that documentation to offset to where, in the case I just mentioned, $700,000 walk away, you have $200,000 of receipts of improvements. And let's just say you're paying a contractor $200,000, then now your walk away is back down to $500,000, which if you're a married couple, you live there 2 years, you do not pay taxes on that. So that's really one big important note to know. If you've lived in the home 2 years or more as your personal primary residence, can't be a rental home, can't be a vacation home, it has to be your primary residence. Single, you pay no taxes on $250,000 profit. Married, you pay no taxes on $500,000 of profit. So we got that out of the way. Now, what happens, right? You get me back to like 2021. Somebody bought their house in 2020, and 9 months later, divorce situation happens. They need to sell their house, but because of what the market did then, the house is worth, $80,000 more. Now, you've not lived there 2 years. That's the key. Not lived there 2 years. Actually lived there less than one. So if it's less than 1 year, it's considered short-term capital gains. So what that will do is the profit, again, everything is going to be the profit, will be taxed at your tax rate. So depending on what tax bracket you fall in, you will be obligated to pay that on the profits. Let's say you're in the 24% tax bracket. So if you're in the 24% tax bracket and you make $50,000, you will be obligated to pay, again, when your taxes are due, 24% of the $50,000. So let's just call that, we'll call that easy numbers. Let's just say $12,500 is what you would owe at tax time on the profit of $50,000 if you've had it less than a year. So that's the key. Less than a year means it goes to your tax bracket. Now, what happens if you have owned it between 1 year and 2 years? There are some tiers, somewhere between 10, 15, and 20%. Right now, 20% being the highest you will pay. So that's actually less than the 24% tax bracket if you were in, again, if that's what you were in the less than a year. So it gets cheaper to hold on to it for the, at least a full year. As the most you would pay would be 20%. A lot of people are going to fall in that 10 and 15%. Now, there are a few loopholes to capital gains. I don't know enough about those to really explain or give a good opinion on, but I do know there are some loopholes based on having to relocate for a job. If you make under a certain amount of money in a certain area, like a poverty level. So make sure you talk to a good CPA, an EA tax advisor on that, because again, there are some loopholes that can get you out of paying capital gains that you can explore other than just what I'm telling you. So that right there covers basically your average person, right? Your average homeowner. If you have a home less than a year, you go to sell it, it goes to your tax bracket, is what you pay taxes on the profit. If you have it between 1 and 2 years, you have a max. All right, we froze, but we're back. So most likely, anywhere between 10 and 20% is what you would pay there. So that is, yes. So that's good. And then if you have lived in it 2 years or more, single, meaning you're not married, $250,000 of profit, tax-free. If you're married, $500,000 of profit, tax-free. So we've covered that. Now let's talk about investing, right? If you have a second home or rental property investment, right, you are going to be subject to the same type of capital gains as if you've owned it less than 1 year. It goes to your tax bracket. If you've owned it, basically 1 year or more, it goes between that 10, 15, and 20%, but it is what it is, right? If it is not your primary residence, you will pay capital gains on that. And that's where a lot of people, I don't want to sell it, or you hear the term 1031 exchange, which is what we would do with our properties. Therefore, deferring capital gains and moving all basically profit over into another property, right? That's how in real estate, if you're going to get into real estate, you don't get into real estate rental properties to eventually sell out, because you are basically trying to take advantage of the tax benefits, which is essentially the top two most important things, along with cash flow, is the tax benefits of owning it. So that really covers what I would say the majority of it. So let's talk about why it's not that bad. I don't freak out over capital gains. It's not a big deal to me. I think people make it into something that it's not, because ultimately it essentially is free money. It's money you would not have had otherwise. So the example that I was thinking of in my head, let's say you make $80,000 a year, and then somebody comes to you and say, hey, I want to offer you a job, and and you don't got to do anything for it, but I'm going to pay you $100,000 a year. Well, you're going to say, well, do I got to pay taxes on that extra $20,000? Of course you're going to pay tax on the extra $20,000. It's income. So it's the same thing. You're basically paying tax on money that you didn't essentially do any earn. You earned it passively. You were just living in the home. So that's why I don't think capital gains is really a big deal. And ultimately, as long as you've lived in the home, call it a year, it's going to be less than probably what your tax bracket even is. So when people call me and they're like, hey, I've had my home a year, or whatever I want to sell on my rental properties, but how do I get out of paying capital gains? Listen, like, this is not a big deal. You're paying money, taxes on the profit that you didn't have otherwise. And that's just my opinion on it, right? Again, I don't want to pay taxes. We do everything possible from a legal standpoint, from the cost segregations and the rentals and how to do all the proper write-offs, exploit all what I would say is the legal tax loopholes. And we have a very expensive CPA that can do that for us, and I'm all about it. But ultimately, right, if I was to sell a property and it was worth $100,000 more than when I bought it, why am I going to be mad on paying 20% of $100,000? So I'm going to give 20 grand and I'm going to get back $80,000 that I didn't have because the home just went up in value. I'm not going to be mad over that. So again, just wanted to just kind of share a different perspective of capital gains. Because again, it's very, very common. People just hear it and like, oh my gosh, it's the worst. It's not really that bad. And for the most part, it's probably even less than what you typically are paying on your W-2 job that's paying you anyways. But as always, questions, thoughts, concerns, anything, all things real estate, obviously insurance now. I'm always happy to help, and I always want to kind of keep sharing the knowledge that I learn and go over topics that are, I commonly come across to educate people, because there's a lot of bad information out there that's just clickbait versus truthful information there. So y'all have a great day.